Okay, I had to change my memory card. It started to form a union one at a coffee break, so hey, go figure. What I was referring to that where the Dow and the price of gold actually meet doesn't really matter, because I will be able to tell when the ratio gets close that it's probably within a year and a half of the point where I'm going to actually liquidate gold stocks, and then you would go back and buy Dow stocks or say Canadian bank stocks as an example. So in 2010, where are we? This is now the first trading day of 2010. The Dow is at the 10,004 level, give or take a couple points, and the price of gold is around $1,100. There's still a 10-to-1 ratio. Before this chart is complete, when I'm looking at this, which is a 100-year-old cycle, this chart is indicating that it's feasible this time that the price of gold may actually be higher than the Dow. And I think that's very feasible when you consider this is a super cycle decline for Dow stocks. So at that point, let's assume that, let's say the Dow goes to 3,000, price of gold goes to 6,000, just as an example. That would be a phenomenal buying opportunity for the Dow stocks. In Canada, it's multiplied greater because the Canadian dollar is very much expected to go to 160, maybe even 180 US. So one Canadian will be $1.60, $1.80 US if they don't just take over our currency in Canada altogether, which there have been rumors about this for quite some time, going as far back as the early 1990s. When the Canadian dollar is at a peak, Ontario will basically be bankrupted, by the way. Part of the U.S. plan is, as they collapse their currency, 86% or 85% of the products made in most of Canada are sold to the U.S. market. Ontario, which is largely a manufacturing province, they're going to force Ontario companies to go bankrupt or move south and hire American workers, and goodbye to Ontario's economy, on top of the fact that we are the welfare capital of the world right here in Toronto. Not just the welfare capital of Canada, but of the world. It's ridiculous. And that's going to end up being very painful, but that's another day and another dollar. So here's the thing I want you to focus on here. Just by following these cycles, you don't make trades in theory. You don't have to be watching every day, because these are long cycles. And I simply took $5,000, didn't account for income tax, but by the same token, I didn't account for the fact that you would be, as you make more money on your earnings, you would be buying more shares or more units, whatever. But 5,000 there at the end of the first cycle, based on how these performances, how you keep switching cycle by cycle by cycle. You can see here 614%, then 800%, then 1,000 and 1,000. By the way, this chart goes further. From the year 2000, the Dow was down maybe 20% in that range. At one time it was down over 50%, and before the next decade is out, it's going to be down a whole lot more. But just going from the year 2000 till the end of 2009, the Dow is down, let's say 20%. Gold stocks are up over 1,000%. So you can see these patterns are just repeating over and over and over. This time I expect the HUI gold index started in the year 2000 at $35 a unit, reached, I think as of the last trading day, it was trading in the 435 or 440 range. So you can just do the math on that. So just get a calculator. Start here at this cycle of 5,000. The end of the first cycle, 1940, it's at 30,007, and then you get an 800% increase in the Dow. Now you're at 245,246, and then you get a 1,000% increase in gold stocks in that commodity cycle, and that's right here to 1980, and then you're at 2.6 million. Then you get almost 1,100% in the Dow surge from 1980 to 2000. Now you're at 28.9 million. Obviously there's some tax due. When you get into a case like this, you don't have to file tax. They'll come and file it for you. Ha ha. But we're not done yet, because this cycle here, when you sell Dow and you buy gold stocks, has now also gone up 1,000%. You can do the math. I mean, this gets ridiculous. But this is a cycle that is over 100 years old. So buy and hold does not work every second cycle. You must get away from basic Dow stocks and get into commodity stocks. That's just the nature of these cycles. Okay, I just want to highlight for a minute or two these two charts here. On the top you have the Dow Jones Industrial Average from 1914 to 2005, and on the bottom you have US gold stocks from the very same period of time. Here's what I'm trying to highlight. Every second cycle it's better to be out of the Dow and into gold stocks. And remember, this is going from 1914. You're talking pretty much 100 years of data. Take a look here. In the 1920s, the Dow is going up. Gold stocks are going down. And I'm just checking to make sure you can see that. Then what happens? The Dow crashes. And actually fell 89% there, by the way. Gold stocks go on a big upswing. And in fact, they kept going up right until right around 1940. At that time then and by the way, gold stocks went up about 600% in that time frame. Dow went up about 400% in this time frame here. And then from 1940 to 1966, what happened? The Dow went up 800%. Gold stocks went nowhere. They just formed a multi-decade triangle, just up and down, but not going anywhere. Then from 1966 until 1982, look at the Dow. It went nowhere. And just look over here, by the way, just as a point in case I forget to mention this. From 1929 until the mid-50s, the Dow Jones went nowhere. It took 25 years just to get back even. So I mean, that's just another point in and of itself that it's very important that if you just buy and hold long term, you may lose. If you were starting here to save, that's quite painful, to say the very least. What about the people that were retiring there and literally within 3 years their portfolio dropped 90%, so there's no money left in no time at all. So from 1966 to 1983, Dow went nowhere. Hit 1,000 so many times over and over, but could never get above it. Had multiple crashes in the 1970s, but gold stocks went up 1,000%. Then the switch up here, 1980, the gold Dow ratio is basically 1. The gold goes across and down. In fact, gold stocks fell from the peak of, I'm talking about the Usurex as an example, and the Barron's. From the peak of 1980 till 2000, gold stocks fell 95 to 98%. But the Dow went up 1,100%, from 1,000 to 11,700 in the year 2000. So what I'm trying to get at, if you just follow the mouse, 400% up, and you switch down here, you get 600%. You go back here, you get 800%. You go back to gold stocks, you're up 1,000% in the 70s. You go back to the Dow, you're up 1,100%. Now in the year 2000, the Dow has gone nowhere. In fact, it went from 11,007 down to about 7,200, went back to 14,000, and then crashed all the way down to 6,500 so far. And that was an A-wave decline. It's on a recovery now. It's got a long way before it's going to hit bottom. However, from here, gold stocks are up 1,000%. One last time so you get this. Somewhere around 400%. 600%, 800%, 1,000%, 1,100, and 1,000, just by switching from Dow stocks to gold stocks every second cycle. Absolutely a glorious chart.